Hi everyone, good morning. Happy Friday. We've reached the end of the week and you can look forward to your weekend where you recharge and recuperate from the week. I hope all of you have a wonderful weekend ahead of you and you do get to do the things you've been looking forward to. That being said, so today I'll talk about this misconception that a lot of investors have that you can time the market. They always keep asking me on Instagram and on LinkedIn now and Twitter, sir, how do we time this market? How do we know this market has reached its peak, we should sell, or this market has reached its bottom, we should buy? Then it gets into individual shares. Should we buy? Should we sell? So I thought I'll talk about this today and why it's important to always stay invested. There is no buying and selling. If you want to see returns, you have to be invested, and you have to be invested in the long term. So there's two primary investment strategies which we can divide them into. One is called the market timing, trying to predict the market movements or buy and sell at optimum times. The other is to buy and hold, holding investments for the long term. And you know me and Anand, we believe in buying and holding for the long term. The reasons why we say you can't time the market is there are lots of challenges associated with timing the market. Difficulty to be consistently on the dot and timing the market right is very, very hard. Even expert fund managers, forget us, forget me and you who are just nascent, we're just starting. We're like toddlers, we're trying to figure out what to do, and we are so confused. So let's look at the other spectrum, so-called the Dhonis of market timing, the fund managers. And they're the experts, they're the dream team. Even they underperform compared to market indices. And we've spoken about this, and we've spoken about Warren Buffett's bet, and it's very difficult. And the reason why it's very difficult for fund managers to overperform the indexes, a couple of them. Anand, of course, talked about the cost is one. The other is unexpected events can always impact an investor's plan. This is true for fund managers. You do not know when the economic downturn will happen, or when a recession is going to happen, or when the pandemic is going to happen, or a war is going to break out. You can see some kind of signals, but you can't time it. There's a difference. Knowing the signals and timing it are two different things. It's like knowing there's a cyclone coming and knowing where it's going to land are two different things. Everyone knows a cyclone's coming, but no one can say where exactly it's going to be, where it's going to land. So continual trading can lead to additional costs. There's another thing which a lot of you have been asking me, sir, I buy at a low cost and I hold. Then when I see the profit, I sell. And even if I pay the tax and everything, I still make. No, you don't. If you compare it to long-term investing. If you buy, let's say, a company A at 90 rupees and you hold it for 15 years and you sell it for 9,000 rupees, that compared to buying the same company at 90 and selling, buying and selling and buying and selling all the way to 1,000, and now and then dipping and taking your profits and reinvesting, dipping. If you see all the costs, additional costs which you incur through taxes and trading costs, which continually keeps adding, you will not. That is why I say buy it and don't sell it unless there's a reason to sell it. There's a goal which you have in mind. When that goal is reached, you can sell. Or there is a reason. There's a sudden unexpected event in your life and you need the money, definitely go ahead and sell it. Then there's lots of potentials, pitfalls in this kind of thing which you do, which is missing out the best days in the market can significantly reduce your returns. For instance, missing just 10 days of the best market days in 20 years can halve your returns. So what does that mean? 10 days, the market's being in its lowest or the market's being its highest. Those 10 days out of a span of 20 years, you don't invest on those days. Your returns can be lowered by half. It's not something I'm pulling out of my head. You can try and just open an Excel sheet, punch in some numbers, some fake numbers, and see what happens over 20 years and remove 10 days out of those 20 years where the returns would have been exceptionally high or exceptionally low, where you would have entered the market or exited the market, and you see those days you missed and see what happens to your returns. So that's why I'm saying consistent investment and a long term is what you should be looking at. And why do I go on harping about this long-term investment? There's certain fundamental advantages or benefits of being long-term. First one is the eighth wonder of the world, as Einstein said, compound. You compound your interest and reduce your risk over time. And these are so advantageous, you can't understand it till you start doing it. And you start seeing these results. When you start putting a little away, and you keep chipping at it, you will see phenomenal returns. This is true in everything which you do, including weight loss or any form of thing which requires an effort of doing it habitually over a period of time. So even if you say, let's say we take the challenge of 10,000 steps a day, you won't see the first benefits in the first week or 2 weeks or even 3 weeks. But suddenly, in a couple of months in, suddenly you'll start seeing your stamina improving, your sleep improving, immediate changes in your life will start happening. The same is true with compounding interest. You do not see the returns in your shares and your stock and investment immediately the first few months or the first few years, but over a period of time, you'll start seeing such returns, you can't even argue with it. So that's why I'm saying give it a shot. Try. If you don't believe me, you can open 2 accounts. Like one of the fellow members I was talking to in our fellowship, I was telling him about it. He had 2 different accounts. I said, in one account, you can try doing compounding. The other account, you try doing your trading, which is buying and selling and highs and lows, and see what happens for a period of a year or more and see the kind of returns you're getting. So you can do that experiment yourself with Anand's tea coffee money and see what happens. An investor wouldn't have lost money in the US stock market or the Indian stock market if they had invested at least 15 years, regardless of when they started. If you see the stock market index from 15 years back to now, be it the American index if you've been in the US or the Indian index for 15 years back, you won't have lost money. Companies come and go, things happen, pandemics come and go, wars break out, financial disasters happen, but market always recovers and we keep on moving forward. And even many of these ETFs which you see, these funds which you see, they've always been reactionary and they're consistently claim they're providing returns, but they may not be providing returns because most of these large ETFs which you see have been created because of a major crisis. Right after the dot-com burst happened, the downturn happened, there was an ETF which was created. Same way, if you track these ETFs, when these ETFs were actually created, most of these popular ETFs which you see have all been created right at the time after a major downturn in the market. So even they cannot be claiming to be, they're able to see the disaster coming as they claim. All these returns are only there in hindsight. And having some patterns like investing in growth or momentum stocks as they call, you can now outperform indexes in periods of time. If you have a short period of time, you're looking at a 1 year period or 2 year period and you have these momentum, you can argue these. But when you look at it on the long term, staying invested consistently, nothing beats that. Investing in the index can provide stability, simplistic, and whatever specific strategies you have, they don't return like this because simple reason, even if a bank goes bankrupt, even if something fails, the index never fails. And you don't need to believe me for it. If you just open up the index chart of any index you take, any countries, and you look at it over a long period of time, indexes never go bankrupt. I'm sure I'm going to have a lot of comments saying this index, this country, yes, there are outliers in everything. There is no 100% guarantees in anything. But I'm only purely talking about the Indian stock market and the American stock market specifically, because most of us who consume this channel seem to be investing in either the American or the Indian stock market. So my specific, lines of reasoning are based for these two. So keep that in mind. This is why I say investing in the long term and being invested consistently gives you much better returns. So I hope you found this video interesting and gave you some clarity on why I'm saying you should be invested in the long term and start investing now. It's like I said in another video, it's never too late. Start now and you can always keep on investing and keep growing. That being said, thanks for watching the podcast today. I hope you have a wonderful day ahead of you as you get into the weekend, and I'll see you in the next one tomorrow. Thanks.